Sutton S. D. Cassie.
And Mr. James Levin.
Here.
Mr. Eddie Brown.
Leroy McGinnis says Eddie Brown's proxy.
Mr. John Kelly.
Leroy McGinnis says John Kelly.
Mr. James McGowan.
Here.
Mr. John Farina.
Here.
Mr. Paul Furrow.
Here.
Mr. Thomas Phillips.
Here.
Commissioner Douglas White.
Here.
24 votes in a quorum. We may start the meeting.
Public agenda.
Okay, so we have just the December review. We have no special items for the agenda. We're going to go through December. You can see it on page 39. It's going to be in this book here.
What do you know?
I'm holding up the monthly performance review. It's the flip book. And you can see the total portfolio is down about 0.5%, 53 basis points, versus the benchmark down 79. So we picked up 26 basis points in the month of December. We're now 42 basis points behind for the fiscal year to date, about 1%. If you look over two columns, you can see the fiscal 2014, reminding you, was 17.5%. We're now halfway through fiscal 2015 at a much slower pace as we sort of anticipated. We thought we were borrowing returns from future years last year, and if the first half of the year is any indication, that is certainly the case. The market's been very choppy. Choppy markets are good for those who rebalance, and so our rebalancing program that we started putting in at mid-year is paying off. We take money from the U.S. equity markets when they're up and give them to the international markets. Then the international markets are up, and the U.S. markets not so much, and we end up picking up money with that trade. We don't have any predestined ideas about which markets can outperform the other. We're just rebalancing to a constant mix that we've spent time with the consultants determining is a good mix for the portfolio over time. So this philosophy of rebalancing is a proven way to handle the tactical asset allocation process. And if you turn page 30, I think. Sorry, I should have had it marked. Nope, page 32 in this book. Kind of shows you what I'm talking about. You'll remember this from prior quarters. When we started in July, the bar way over in the left, U.S. equities, was way up towards the upper band, up about 6%. And we decided to go into a policy of rebalancing, so we worked that down. We were underweight the international markets. We worked those up. Those are the next two bars. And as you can see, we're pretty flat across equities. That's the grouping on the left. We're almost right on our long-term asset allocation. Over in the fixed income area, we're also not too far away. You have to take the gray bar and the blue bar and put them together. The gray bar is bonds or loans less than 5 years. The blue bar is loans more than 5 years. We have a policy to be in longer-term bonds over time, which is good for all environments except for an environment like we're in today, where interest rates are unbelievably low, and you have more vulnerability with long-term bonds to rising rates than short-term bonds. So what we do is to put more money in short-term bonds that get picked up here in the gray. The mayor's office has asked us to come up in another board meeting, come up with a report that shows you the combination of the two and looks at the duration or the sensitivity to interest rate changes across the whole board, and we can compare the combination of our cash and long-term bonds with the overall bond market as proxied by the Barclays Aggregate Index. And we're close to having that report, hopefully at one of the upcoming meetings, and certainly at this next meeting here at FIRE. So that's where we stand today. I'll let Martin take you through some of the dynamics. There have been a lot of crazy movements of late, and he's got some great charts on it.
Scott, can I ask you a question?
Yes, sir.
When the long-term bonds that are like, you said, like up to like 10 years, some of them could be?
Yeah, Yeah, more than 5 years, there would be 5 years plus.
So when you want to try to balance it out a little bit, then are you getting rid of the longer term bonds for shorter term bonds? Or
No,
are you buying more
what we've been doing, Paul, is when we had too much equities, right, so too many stocks, and we sold out of the stocks, and if this were a normal environment in bonds, we would have bought more of the long-term bonds. But since we're concerned about the interest rate sensitivity of long-term bonds, we bought shorter-term bonds instead. In fact, we bought mostly 2-year U.S. Treasury securities, so very safe. They're not paying much interest rate, but they also have much less sensitivity to interest rates than the longer-term bonds. So as the economy continues to improve and interest rates begin to approach more normal levels, then we'll take money from that gray box, the short-term bonds, and we'll start feeding them into the longer-term bonds. And we will have avoided, getting extra valuation. We still own lots of long-term bonds. It's just we're allowing the portfolio to be somewhat underweighted.
Okay, thank you.
Barney?
So we've done this in prior months, so I'll try to be brief. If you turn to pages 15 and 16, you'll see that the dollar has strengthened considerably on page 15. It's near decade highs. Compared to the euro, which is the biggest partner within that for the U.S. and also within the weighted dollar index. Finally, the euro is weakening. It is weakening for several reasons. The most obvious is that you read in the paper there's all sorts of problems about the U.S. structure with Greece and with other issues. They're arguably in or out of recession, depending on your definition of that. They're certainly, regardless of what your definition is, they're at very slow growth. And their interest rates, their central bank is taking steps similar to what our central bank did several years ago. They're so equivalent to what we had as QE3, QE2, and QE3, where they're buying bonds to support the market, and also what that means is that yields have come down considerably. So investors look at Italian government bonds and Spanish government bonds and U.S. government bonds, and interestingly enough, they all have similar yields, yet the credit profile is very different. And so investors see the U.S. as being several years ahead. The U.S. is growing. That's what some of the other charts are showing. Europe is not, but yet the yields are the same or very similar. And so there's been more demand for U.S. Bonds, and that has that's partially responsible for not entirely, but partially responsible for the dollar to finally increase versus the euro, and also why the yields on for instance, the 10-year Treasury, we have a chart on that later, why that remains very low, even after the Fed is out of the QE3 business. If they're not buying it, why are yields so low? The yields are so low because of the comparison. Are you going to buy other sovereign bonds that have lower yields but worse credit profiles? And those countries are in recession or on the brink of it, whereas the U.S. economy is much stronger. We have a new chart on page 17. I think we had it last month, but it's instructive. It shows the price of oil all the way on the right, down 50%. This has driven a lot of what's going on in the markets. High yield, for instance, has a significant energy component to it, and so as we'll go through with the markets later on, you'll see high yield usually has a correlation to equities, but in this case it's gone down because of the exposure to energy. The VIX, you can see on the right on page 18. Well, it's hard to tell from here, but if we blew it up the last few months, it's definitely going up and down. It's calming down lately because the equity markets have gone up to new recent highs, actually all-time highs in the recent weeks. But earlier in the year and late last year, there was a lot more volatility and more uncertainty. I mentioned the 10-year Treasury on page 20. When we wrote this book, it was at 199, it was just at 2%. As the equity markets have hit new highs, so the Treasuries have gone up in price a little bit. I'm sorry, up in yield and down in price a little bit. Spreads on page 21 for high yield in red are still wide. They've come in a little bit because of the rally, but nevertheless, a lot of that is driven by the energy sector. Energy is a big part of the high yield market. You'll notice in blue, the the investment grade market has moved upwards in spreads, meaning downwards in price, but not quite as much. And on page 25 is a nice graphic that shows the one-year returns for the three major indexes that we look at on the equity side. In white is the U.S., the Russell 3000, in orange is developed markets, EFA, and yellow is emerging markets, and the U.S. is clearly way ahead. EFA has done the worst, primarily because of the recession or near recession that they're in most of the, or some of the areas, as well as the currency, significant currency devaluation. When the currency declines versus the U.S. dollar, even if the stock price goes up, if the currency declines more than the stock price goes up, if you're not hedged, you will lose money. So how did the markets do in December? Scott mentioned the negative returns in December. The Russell 3000 equity markets were roughly flat in the U.S., but as I mentioned before, because of the currency, the next set of columns I'm on page 27. It's hard to read on top. It's right after the charts. EFA was down 3.5%, and emerging markets were down over 4.5%. Hedge funds were up. Core plus 5 was up slightly. On the next page, the first section is high yield, and that's why I was referring to equity markets roughly flat, but high yield is doing worse because energy is in high yield, down nearly 1.5%. Tips were down, convertibles were down, and because of that, if we turn to page 31, you'll see that the return for December was down about 0.5%, bringing, as Scott mentioned, the middle bar, fiscal year to date down, up at a little over 1%, but down from what it was the month before. We have a hint of what to expect in January, and that's, if you go back a page, you'll see that the U.S. equity markets in January were down. Russell 3000 was down over 2.75%. Even emerging markets were actually up less than 1%. Core plus 5 was up by a lot, nearly 2.5%. That's really when the interest rates started going back down. High yield was up 60 basis points. It benefited from interest rates going down and was hurt by the energy aspect as well. Tips were up significantly because over 3% because of interest rates. Convertibles were down because of equities. And REITs were the real star, was up over 6%, nearly 7%. And if you look at the fiscal year to date, up over 19%. Just to remind you, FIRE has a 3% allocation to REITs. So for January, I would expect it would probably be similar to what you're seeing in December, give or take. I hinted to you before about what's going on in the market in February. We ran the reports in our office as to where we believe we stand as of yesterday, because the markets are now, U.S. markets are at all-time highs. Yesterday, the S&P 500 hit 2,100 for the first time. It keeps hitting record highs. So when you get, at least as of today, of course today's not the end of the month, we don't know what's going to happen through the rest of February, but as of today, the returns for FIRE are well above where it was as of December fiscal year to date. So we showed 1%, we're now probably in the 2s, close to 3%. As of today, doesn't mean that's what it's going to be as of the end of February. So we made up December and January losses that you'll see next month. In addition, the market value that I estimate, so let's turn to that page. First we have a page showing the history of the market value, so take a look at page 37. December was $10,670 million, down from the all-time high just a month prior, $10.9 billion. My estimate is where we are today is just shy of the all-time high, but that's unofficial, so it's awfully close. So we've made up quite a bit as of yesterday, which of course is not month end. So January next month, you'll still see probably a down month, but February to date has made up all of that, back up to all-time highs. If you take a look at page 39, it shows a summary of all the asset classes with the returns, and subsequent to that on page 40, so a few pages before the end, shows individual managers, and we have real estate and private equity towards the end, the last few pages. Each of the investments as well as the cash flows for real estate and private equity. Those were my comments for now. Are there any questions?
See no questions? Mr. Chairman, we're ready to move on to the executive session when you're up.
Okay. Could you have the cameras turn on, please? Need a motion to move out of the public session into the executive session?